Hello, everyone, and welcome to today's live webinar presented by SCORE Fairfield County in partnership with the Fairfield County Community Foundation on financial guidance for nonprofit organizations. I'm Mike Clem, a business mentor at SCORE Fairfield County, and I'm the moderator for today's webinar. Our presenter today is Bryan Pennington. More on Bryan in just a minute. But first, let me provide you some brief information about SCORE. SCORE is a nationwide organization including over 11,000 volunteers with more than 300 offices around the country, providing free advice to small business owners. Could I have the next slide, please, Bryan? Thank you. SCORE Fairfield County is comprised of more than 130 volunteers with a wide range of industry, process, and subject matter expertise. We offer the three services to small business owners shown here on the screen, all of which are free. Please go to our website at fairfieldcounty.score.org to learn more and to sign up for free one-on-one business counseling. As I mentioned earlier, we are very pleased to partner on today's webinar with the Fairfield County Community Foundation, which does such great work with many nonprofit organizations throughout Fairfield County. At the end of today's webinar, I will talk about a new webinar series that we are presenting in partnership with the foundation beginning in just a couple of weeks. I'm pleased to say that joining us today is Danielle Marchion, manager of the Center for Nonprofit Excellence at the foundation. Welcome, Danielle, and could you please say a few words about the foundation?
Sure. Thank you so much for joining us. Good morning, everyone. My name is Danielle Marchion. I am the manager of the Center for Nonprofit Excellence at Fairfield County's Community Foundation. Our motto at Fairfield County's Community Foundation is "Together We Thrive," and I think this webinar is a wonderful example of that. The Center for Nonprofit Excellence at Fairfield County's Community Foundation is focused on building nonprofit capacity. And I know that this topic is one that is in demand for Fairfield County nonprofits. So I am so grateful. Thank you to SCORE, everyone at SCORE, for helping us put this together. And thank you so much to Bryan for joining us today to share his expertise. Thank you.
Thank you very much, Danielle. Now let me provide some useful information about today's webinar. If you have a question during the presentation, please use the chat window at any time. It's located in the lower part of your screen. We'll be monitoring your questions, have set aside time for Q&A at the end of the presentation. Our webinar will end sharply at 11 a.m. to respect your time. The session is being recorded and the link to the recording will be available at fairfieldcounty.score.org within the next couple of days. It's now my pleasure to introduce our speaker for today's webinar. Bryan Pennington is the Director of Audit and Accounting at Venman Co. He has over 14 years experience and specializes in providing audit, tax, and accounting services to nonprofit organizations and closely held businesses. Bryan is a CPA and a member of the AICPA's not-for-profit community, the Association of Fundraising Professionals of Fairfield County, and the Connecticut Society of CPAs. Welcome, Bryan. We'll now turn it over to you.
Great, thanks, Mike. I'm sorry, I'm looking over here and my camera's over here because the presentation is showing up over here. But again, like Mike said, I'm Bryan Pennington. I'm the Director of Audit and Accounting here at Venman. We're a mid-sized firm located in Shelton. We do a lot of work with nonprofit organizations throughout Connecticut, primarily Fairfield, New Haven counties. We're a mid-sized firm, so we have a nice little team here. And I've been working with nonprofits for, like Mike said, for over 14 years now, on a wide variety, either small nonprofits and large. So I kind of have a good understanding of what the needs of nonprofits and especially the financial aspects of it and how everything affects them. I'll go ahead and jump into the presentation. I don't have an hour worth of content here, so I welcome questions, and I'll be watching the chat box as I'm talking. So I'll kind of try and address questions as they come up, but questions are encouraged because I know I could give my thoughts here about what I think are the best kind of processes or ideas for nonprofits, but questions are encouraged. I know those are what's on top of your mind. So I'd rather address those as you have them. And really this presentation, it's a really broad topic, financial management for nonprofit organizations. You could really go in a wide variety of ways and tangents on this topic, but so I'll just kind of go over some of just the basics of what how I would do things if I was running a nonprofit, kind of from a CPA's perspective, at least financially, just to kind of give you some tips and pointers, and hopefully you take a couple things out of this today that maybe use at your nonprofit. So just to kind of get started, just really the basics of a nonprofit, whether you're in the new phase, the growing phase, or even if you're an established organization. These are kind of some basic things you should be doing on an annual basis for your organization to make sure you're set up to kind of succeed and set up to really kind of meet your mission and program objectives. So especially this first couple points are really for like a new nonprofit or a nonprofit that maybe had to shut off during the pandemic and is kind of maybe trying to get going again. It's, what are your baseline costs to operate? What does the organization bare bones need in order to run its organization, meet its program objectives? What are kind of those baseline of operating costs that you need in order to, on a monthly basis, in order to operate, in order to run? And I think one of the biggest misnomers about a nonprofit is that it's a nonprofit, but really it should be run like a business. If you think about any sort of business, the goal is to create profits for the business so that it can grow and be successful. And a nonprofit should really be run in a similar way. Is the goal should be to create, in order to meet your program objectives and to grow, you need to be able to grow an operating reserves so that the organization can grow and kind of expand on what it's trying to do, and really meet more of its objectives, and not just kind of on the smaller scale. It's really kind of to grow and to get larger and larger, so it can meet more of the program, more of the objectives of what you're trying to do and what you're trying to accomplish. So again, starting with your baseline costs, and then kind of the next piece is, okay, what is a good real estimate of what your revenues are going to look like over the next year? Because then that's what you need to then use to draft a budget. So really, it's really starting with what are those revenues that you expect to come in over the next year, and that could be based on maybe the prior year's revenue, or maybe you know that you're going to be receiving a grant or a big contribution over the next year. It's knowing what your real revenues are expected to be over the next year, having a good number that you could use to then draft a budget of how you could fill out those expenses, because obviously you don't want to have a budget of expenses that's going to exceed your revenues, because that's not a good model, right? You need to have a good model is you have revenues and then you have expenses that are going to fit within those revenues, and hopefully then you're able to build maybe a little bit of a operating reserve within that budget, especially in those first few years, so that when you run into an emergency issue where maybe you lose a grant or a contribution, you're able to sustain yourself until the next contribution or grant comes in. So it's being able to build your organization, especially in those first few years, maybe having a little bit of a budget. And people always ask, okay, what's a good operating reserve to have? I think, and it's kind of a case-by-case basis, but I think in general, it's good to have at least 3 months of expenses in your bank account as a cushion, so that if something does happen, you don't have to just stop and pull the plug on the organization just because maybe you lost a grant or a contribution. So it's good to kind of build the operating reserves. That's one of kind of a really important thing for younger and growing nonprofits to do. One of the, I think, most important things that an organization should be doing is that they should know what your key performance metrics are. So for example, if you are a nonprofit organization that serves homeless, the homeless population, and you know that, okay, if I get $100,000 of income this year, I could serve maybe 500 meals to the homeless next year. So it's knowing that dollar versus program metric, because that's what any sort of donor or funding source is going to want to know, is where, if I donate this $10,000, how is that organization going to use that money? So it's being able to identify kind of what the organization's mission is, what it's trying to accomplish with the money that comes in, and how it accomplishes it, and being able to relay that message to its audience, so that you're attractive to donors and funding sources, because there's a lot of nonprofits out there. So you need to be able to differentiate yourself between the other nonprofits that are competing for similar dollars to show why your organization is important to donate to, and what you're going to be using those funds for. So it's really an important to really kind of come up with some sort of measurable metric that shows, okay, this is what a dollar coming in is going to be used for by our organization. And it's a little bit, I know that's kind of difficult for some nonprofits, because maybe you're creating a program where you're serving, some sort of the population, where all of your expenses are really going to be salaries because you're putting on these programs, but maybe it's going down to the people that you're serving and say, okay, for this $10,000 grant, we were able to help 20 people over this last week to maybe get a new job, for training, or to help them with groceries, whatever it is that your organization is doing. Being able to just like I said, being able to identify to the grantors, to the funding sources, what benefit you're bringing to the table, essentially. So that's kind of the biggest takeaway. I think if anything I had to say, that's kind of one of the biggest takeaways I want you to kind of take away from this, is being aware of what your organization is trying to accomplish through its mission, and how to communicate that to those funding sources. Okay, moving on, emergency planning. So maybe this slide might be a year too late, because obviously this past year was probably an emergency situation for a lot of nonprofits out there, especially maybe ones that were in the infancy phases or growing phases, or on the smaller end. So this is maybe revisionist ideas, but just things to keep in mind if there happens to be another emergency that happens in the future. It's making sure that you're aware of changes that are happening out there and how it's impacting your organization, so that you can act appropriately. And before that, because the last thing you want to do is ignore the fact that maybe there's a pandemic going on, and then 2-3 months down the road, then you deplete all your reserves that you built up over the years, and now you have nothing left, and now you have to stop your operations because you have no cushion anymore, and you maybe lost a couple contributions or grants that you were relying on. So it's being able to act quickly so that you don't eat into those reserves too much, so that when get to the point where, okay, now we're able to get going again, then you have a reserve to then help you get going and kind of push you as you get restarted, so to speak. It's also being aware of what's out there to assist organizations. So obviously everyone, I think, knows about the PPP loan program and how it helps organizations, and all the kind of the benefit it brought to people over the past year in organizations. So I'm not going to dive too far into that unless someone has a question about the loan forgiveness. I'd be happy to help. I'm also trying to get the word out about there's the employee retention credit, if people aren't aware of it. The employee retention credit and PPP loan both came out last year as part of the COVID assistance, but it was either had to use one or the other. So most people chose the PPP loan. and kind of the employee retention credit was kind of a forgotten piece of that of the aid package that was issued. But then in December, when they had one of the revised acts that went out, they then told organizations, okay, you can now apply for this credit retroactively going back to 2020, in addition to the PPP loan that you received. So now you're able to go back to even starting in March 2020 and apply for this credit. And so for people that don't know, this employee retention credit, an organization qualifies for it if it had a 50% reduction in revenue in any quarter in 2020 compared to the previous quarter in 2019, or if there was some sort of government order that caused your organization to not be able to run to its full capacity for whatever reason. Like, for example, the restaurant industry obviously was impacted by government orders that kept them from being able to operate at full capacity, right? Or there's theaters that aren't able to operate because the government has shut down all theater operations and indoor venues like that. So these organizations are able to then apply for this employee retention credit, which is up to $5,000 per employee for 2020, which wasn't available before. So, and I don't think a lot of people know about that right now. So it's really important to look into that to see if maybe your organization might meet the requirements of that credit, because it could be a big number. You have 10 employees that made at least $10,000 last year each, then that's a $50,000 credit your organization can be getting retroactively back to 2020. And then this credit continues for 2021. It's a little different. You only need to have a 20% drop in revenue in one of your quarters to meet compared to 2021 to 2019 in order to be eligible for the credit. And my guess is that there's less government orders out there in 2021, so that your organization might not be as impacted by government orders anymore. But if you had that 20% reduction in revenue in any quarter, the credit's even larger in 2021, where they allow up to $7,000 per employee for each quarter. So if you have 10 employees in the first quarter of 2021, you meet the eligibility requirement, you could get a $70,000 credit for your organization, which is a big deal, obviously. And then you could, if you still qualify for the credit in the second quarter, you could apply for that $70,000 again in the second quarter of 2021. I think it goes all the way through the end of the year. I think they extended it. So that's a big credit that's out there for organizations that have employees. Obviously, that's the big thing is you need to have employees of the organization in order to qualify for the credit. Someone just asked what taxes is the credit applied. It's through your payroll tax filing. So it's on the 941s, that's how the credit gets applied, is when you fill out your 941 on the first quarter of 2021, there's a spot that you put the employee retention credit. So even if you only owe maybe $10,000 in payroll taxes that quarter, but you happen to be eligible for $50,000 credit, you'd put a $50,000 credit there, and then the IRS would give you a refund of $40,000 when you file that tax return. So that's how that works. And then going back to 2020, you would have to then go back and amend your 2020 taxes in order to file for that credit that way, in order to put the credit on the form. That's how it works. And then the IRS would then cut you a check for whatever refund amount you're claiming there. I think that's everything on the employee retention credit. And then it's also just being aware of what local grants are out there, kind of in the emergency situations. I know a lot of the community foundations out there were sending grants to local nonprofits to provide emergency funding. So it's just being aware, being in tune with kind of what's available to your organization to make sure you're maximizing the dollars that you could be bringing in for your organization to help it sustain during emergency situations. And use your local resources for guidance. So reach out to CPAs, attorneys, membership organizations, kind of ask anywhere and everybody, ask your board. So I think that pretty much covers the emergency planning piece of it. And then obviously then once you're kind of past the emergency situation, it's then getting back into the first slide. And okay, then how do we kind of rebudget, knowing as your organization gets kind of back to normal, so to speak, what does the new normal look like for your organization, coming up with a real budget that to sustain your organization then going into the future. And what's your new, maybe your program services and accomplishments, maybe what you consider your key performance metric, like I mentioned before, maybe that changes. Maybe instead of providing, I don't have a good example off the top of my head. Instead of doing one thing, you decide that you want to shift some of your resources to provide tablets, maybe for underprivileged students to help them for remote learning, that maybe some kids don't have access to electronics that will help them and families kind of get back during the remote learning part. Maybe that's what your organization did. I don't know. But that's just one example of how maybe your organization might have used like an emergency like the pandemic to kind of pivot and change maybe some of its programs to help the community and the changing needs of its community. Okay, I will go forward here to the 990 and the financial statements. I like to talk about these documents because these are public documents that funders will use to evaluate whether they want to give to your organization. I'm guessing I'm talking to a lot of the kind of smaller nonprofits out there, so maybe audited financial statements aren't required for your organization, but the 990 is required by everybody. So if you have over $25,000 in revenue, then you're required to file at least a 990 EZ. And so it's important to know that this is a public document. It gets uploaded up to GuideStar, so you can go on guidestar.org and search any nonprofits 990 that you want, and look at the whole form and look at everything that the organization has and has disclosed there. And it's important for an organization to be aware that this is a public document and to know the message that's being conveyed in that 990. And then for those that have financial statements, is being aware of that it is also a public document that funding sources can request from you, and being aware of the message that also is conveying in it. So it's knowing on the 990, there are plenty of areas in the document to really describe what impact the organization has on the community and on what it's trying to accomplish in its programs. So it's making good use of that. This is really kind of a marketing tool for your organization, making sure you kind of use it that way. Don't just have your maybe bookkeeper or accountant or whoever's doing your books kind of do a quick review of it and then accept it and pass it around your organization. Pass it to, if you have development people, pass it to your development people. If you have marketing people, pass it to them. Make sure your board has a good look at it, because everyone should have different, it's good to have different sorts of eyes on this to really see what the message is being conveyed in the 990 to the public about your organization, to make sure that that's really what you want to be conveying, right? And it's also good on your 990 to look at some of those financial metrics. So maybe if you're telling a funding source, yes, for every $1,000 that comes in, we're granting out $800 to local nonprofits, you better make sure on the 990 that your 990 mirrors what you're telling your donors. Because if they look at your 990 and only see $200 granted, maybe you have an explanation somewhere that you need to address. So you need to make sure that the message that you're kind of preaching to the 990, that through the 990, it goes along with what you're kind of preaching to your donors. question here. The 990 is required to be filed electronically. Do we have to file a request for extension electronically also? I don't know off the top of my head. I don't think so, but I don't know that for 100% sure. I know for a lot of our clients, we do it mostly electronically. I don't know if that's a requirement off the top of my head or not. So I don't want to commit one way or the other on that. Another question, communicating budget shortfalls appropriately to public is very important, can impact getting mortgages or other loans. Often it's explainable, sets up next year's budget, how to spend this in the 990 and audited financial statements. Okay, so if you have, especially this past year, right, we had a pandemic. So a lot of nonprofits maybe hurt a little, or even a lot from the pandemic, and maybe you're showing a big loss this year. It's maybe just kind of explaining the situation. Sometimes it's just being about honest and just being upfront and addressing the fact that yes, we had $100,000 loss this year because we lost maybe a large grant that we usually have. So in order to pivot, we have done X, Y, and Z in order to address this kind of budget shortfall going forward. And maybe it's just a matter of kind of addressing, anytime you have a loss, it's just addressing it in the financial statements and explaining it. So it could be that you had a PPP loan in 2020 that's still sitting on your books as a loan because the loan forgiveness hasn't been accepted yet. But you incurred the expenses in 2020. So then your expenses, you're going to say you had a $100,000 loan from your bank for the PPP loan, you would have incurred those expenses in 2020. So you're going to show $100,000 of expenses, but with no offsetting revenue yet because the PPP loan hasn't been forgiven. So maybe you want to explain that in your 990 that says, although our 990 shows a $100,000 loss, it's because the PPP loan forgiveness covered those expenses, and that is expected to be forgiven in 2021 in full. So that offsets that loss. It may appear that we have a loss, but it's really because the PPP loan just hasn't been forgiven yet. So there might be situations. So that's kind of one situation where it just needs to be explained why there appears to be a shortfall on your 990 when maybe in fact there isn't really a loss at all. And that can kind of go the other way too. Maybe you have a big donation that you received from an estate in 2020 that's showing that maybe it's showing $1 million in revenue or something that's way out of the ordinary for your organization. It's important you might want to then explain that fact. How are you planning on using that? What caused the situation that caused this big influx in revenue? How does the organization plan on using that revenue to meet its needs going forward, and kind of explain why you still need your recurring donors support going forward, because maybe you don't want them to look at your financials and think, oh, they have way too much money. I don't need to donate to them, right? So it's explaining both sides of a kind of a special situation in your financials that maybe looks off from year to year, and just kind of explaining the situation to the reader. So it's making sure each year you're looking at your 990 for any changes so that you could really explain situations and how it affects your organization and the programs that you're doing to the donor. So it's really kind of adding explanations that maybe wouldn't be there otherwise. Another question, can the employee retention credit be applied to the same time period as the PPP loan that was used? Okay, that's a good question about the employee retention credit. So the employee retention credit can be used as well as the PPP loan, but the one thing is you can't use those same salaries that you use for the loan forgiveness that you did for the employee, that you use for the employee retention credit. So say you have $200,000 in wages in 2020. You use $100,000 of that for the PPP loan forgiveness. Then you could only use that remaining $100,000 in wages towards the employee retention credit. So that's kind of how that works. You can't use the same dollars. You can't double dip, so to speak, on the wages for the PPP loan forgiveness and the employee retention credit. It has to be, you have to have more wages in excess of the PPP loan that could be then be used for the employee retention credit. And that kind of plays into the loan forgiveness calculation. So in the past, everyone was just using 100% salaries on the loan forgiveness application because that was just the easiest way to do it. And most organizations had plenty of wages to use for the loan forgiveness because of the extended period that the loan was able to be used for. However, maybe if your wages are a little tight when factoring in your employee retention credit, maybe you want to use some rent or utility expenses as part of your PPP loan forgiveness as well, in order to reduce the amount of the wages that you're using, so that you could use more of those wages towards the retention credit. I know that it's kind of a complicated scenario to kind of just explain, in case I'm making some people's heads spin. I won't get too far down that path, but it is important to kind of weigh that. So it's just to know that you can't use the same wages for both the credit and the PPP loan. So just kind of factor that in when you're filing your loan forgiveness application, and just kind of take that into consideration and kind of weigh the benefits of maybe using some other expenses when you're doing your loan forgiveness. Okay, I think that covers that question. Anything else in here? I guess on the 990, it's also another important thing that grantors and funding sources look at is the program service expenses versus the total expenses. That's one thing that I always hear organizations talk about is what's the program service expenses for my organization. So this isn't a thing for people that file a 990 EZ. You don't need to disclose that, but for well, I guess you do it. You have to do it in your program service accomplishments. So you have to disclose what percentage of your funds that you expend are being used for direct program accomplishments, program services, and what expenses are being used for administrative purposes. So what you don't want is obviously you don't want to be showing more expenses on the administrative side than you're using for your program, because then the donor is going to say, why am I donating my money just to be used for an organization's operating costs? They want to see that the money that they're donating is going to be used towards a program, towards you of accomplishing some sort of mission of your organization. So typically kind of a good just kind of threshold, you want your expenses to be somewhere around that 70%, 60 to 70% line for program expenses versus administrative. So that's just kind of something to look at on your 990 is make sure you're not maybe over expending on the administrative side. Let's see, anything else here? Explain special circumstances. I think we went over that. How has organizations adapted its programs? Okay, so this is another good thing to add in the 990, especially in 2020, where we have the pandemic and maybe there's changing needs in the community. Like I mentioned before, it's if the organization did something kind of special out of the ordinary to help the community, this is a great way to communicate how your organization pivoted during a time of the pandemic to help the community during this time. It's a great way to kind of get that message across to your donors, how your organization is really effective in managing the pandemic and how it really helped the community and made sure it was still a useful part of the community and an important tool. So it's just a good way to maybe get across maybe any changes that happened during the year and how you, again, met the needs of your community. Okay, going forward here. Okay, I'm going to kind of break off from the idea of the 990 and the financials and get more into just the internal controls. I think sometimes it's a forgotten or ignored part of a nonprofit organization, but checks and balances are very important for a nonprofit because the last thing you want is for some sort of fraud to occur that essentially wipes out an organization or gives bad press to an organization because there is some sort of theft of cash or misappropriation of assets or some sort of fraud that occurred. So it's important to have checks and balances to minimize opportunities for fraud, no matter how trustworthy everyone is. I know everyone wants to believe that everyone within the organization would never do such a thing. There are myriads of cases of this happening. So it's important to just have those appropriate checks and balances to minimize the opportunities for fraud or theft, right? So it's having checks and balances, having good monitoring controls. So even monitoring controls, that's a great way to get the board involved in the process, especially maybe your treasurer at least. They don't need to be involved in the day-to-day bookkeeping process of your organization, but if they could at least maybe review your bank statement on a monthly basis, and definitely they should be reviewing your financial statements on at least a quarterly basis to make sure nothing out of the ordinary is happening. So it just adds an extra layer of controls to money that's coming in, money that's going out. IT access controls is another, that it's only becoming more and more important these days. So it's knowing who has the ability to change, who has the ability to access certain software. So even though maybe someone isn't the bookkeeper of the organization and isn't responsible for recording the accounting of the organization, but if they have access to your accounting software is QuickBooks, since I'm guessing that's what most people use. If that person has access to QuickBooks, even though they're not the bookkeeper, then they have the ability to alter and change things in your accounting, even though they're not technically, that's not one of their responsibilities. So it's making sure your bookkeeper is the only person that should have access to your QuickBooks, and then maybe a board member then could be a second person just to have that second person on there. Another big thing is ACH payments or bank transfers. That's another big thing that people have been moving more towards, especially during the pandemic, because more people were working remotely. So it was just a lot easier to kind of conduct business that way, to do electronic transfers and stuff. But one important thing I like to point out is you don't want your bookkeeper having the ability to transfer funds. You don't want the same person that's recording your accounting transactions to have the ability to transfer funds or any sort of manipulate funds anyway in your bank account. That's why when you have check signers, the check signers are usually your executive director, maybe a member of the board. It's not the bookkeeper. It's because you don't want the same person that's recording your books to also have the ability to then write a check or send funds out to anyone that they want. So that's really the biggest part of, I wanted to make sure people are aware of the kind of that IT access controls and the ability for electronic bank transactions. Make sure that they're aware of who has the ability to do those transactions, and to make sure there's limits involved with who has the ability to access some of these functions within your bank account or your QuickBooks or your accounting software, whatever you use. Someone asked, okay, any recommendations on how to have separation of duties if you want to move to a paperless accounting? There's a couple little slides here I'm gonna get to that maybe have some suggested kind of checks and balances. Let me go ahead and I'll shoot that over now. So here's this is from the AICPA. It's just okay, say we're a small organization, we only have 2 individuals, maybe we have a bookkeeper and we have an executive director. What's a good way to maybe set up checks and balances so that not one person is doing all phases of an accounting transaction? So if you could kind of read through that, I'm going to read through a couple of these questions that just popped up. Any recommendations on how to have a separation of duties if you want to move to paperless accounting? So it's setting up the ability to still have those those initials of the whoever's approving, is making sure that's still following that process. So if there's a way for so say the executive director is approving an invoice, and then it gets sent to the bookkeeper for writing the check, and then it goes back to the executive director to sign. So it's making sure there's that process. Okay, on the invoice, somehow the executive director signs that invoice, and it's identified, and it's kind of uniquely identified signature. You could use, there's a wide variety of different kind of checks you could use to authenticate someone's signature, either in Adobe Acrobat, or just if the executive director has an ability just to print an invoice, put their physical signature on an invoice, and then scan it in and send it over to the bookkeeper for processing. Then they can do the check and send it back to they mail it over to the executive director for processing. Or if it's a electronic transfer, a lot of banks allow for kind of a two-factor authentication process for any sort of bank transfers that happen. So maybe the bookkeeper will initiate the transfer, just like they would write the check for the executive director. Then instead of a check going to the executive director for signature, then the authentication instead goes to the executive director to approve the transaction and for it to go out. So it's having multiple layers. It's keeping that multiple layers in your control process, even if you end up going to a paperless method. The next question was, small organizations often have just one accountant. Do you have board members do small internal audits on different areas on a rotating basis? So this kind of falls into the kind of what I'm showing here. You have maybe just a bookkeeper, and then maybe you have to have someone other than a bookkeeper in your organization. You have an executive director. If there's no executive director, then you at least have a board. You should have a board president. That's a signer. Obviously, you don't want your bookkeeper doing all. You shouldn't have any sort of signing responsibilities. So just making sure you just have two people that are doing a couple of different things to create some checks and balances. I'm gonna go to the next slide. So say maybe you have three people. This would maybe be a good way to divvy up three responsibilities. There's another question. Do you have a good example of an accounting manual laying out processes, internal controls? Well, I think that's kind of what we're doing here. So maybe that question came in before I started going through these different ways to break out processes. Someone asked, I receive an email from executive to pay. I believe this is good enough for internal control. Yes, I think so. I would, for every sort of expense that you have, I would take that email attachment and put it with the expense invoice so that you show documentation that this was approved by the executive director. I still wouldn't have the bookkeeper have the ability to do electronic transfers though, just because that eliminates the whole point of having separate check signers. Or if it's a lot easier for whatever reason, just operating wise, it makes more sense. It makes sense to have the bookkeeper initiate that transfer or a payment from a bank, have someone else make sure there's a second person in that process that either gets a notification of a payment at the bare minimum. So that's my thought there. Another question, what is the web address for the resource Bryan just mentioned? I don't see it in the chat. Are you referring to just this, these resources? This is kind of from the AICPA. It's from, you'd have to be part of like their nonprofit membership. So I'm a part of their nonprofit membership database. So I have access to kind of some of these suggested internal controls. I think that's what maybe you were referencing as for my resource. Let's see what else. Should the person opening the mail be entering checks, credit cards, and your donor database, not quick? For your donor database, I would have that the donor database, I would have that being managed by if possible, by someone in development. Because it provides an extra layer of support. I'd like to see someone other than the bookkeeper managing the donor database, because then if there's any sort of discrepancy, maybe you could you could say, okay, what do we have in this database that we don't have over here? And it provides maybe checks and balances, because if the same person is doing both of them, it kind of eliminates the purpose of having a donor database, at least from a reconciliation perspective. So I would have someone else other than the bookkeeper managing the donor database. Someone asked, we are paying through the bank and don't cut paper checks. We have only one person doing everything. What would you recommend for the internal control? So I would say for paying the bank, paying through making electronic payments, having someone other than the bookkeeper authorize those payments to be made if possible. That's the best way to do it. You have the bookkeeper recording transactions, have the executive director or someone else authorize and send payments electronically, just like they would if they were a check signer on a physical check. If that's not really feasible from an operating perspective for one way or another, then you could set up alerts in your bank to make sure every time there's a bank transfer that goes out, it goes to maybe your board president, your executive director, your treasurer, so that they are aware of the transfers that are going out of your bank. That's maybe another way to at least mitigate that segregation of duties issue. Is maybe it's just setting up alerts for electronic payments to go out. I think I'm all caught up on my questions there. And I think everyone's maybe hopefully had a chance to look at those internal controls. Let me know if you want me to go back to one of those screens, and I could bring it back up for you. Other bookkeeping considerations, just this is kind of my last slide here. So other bookkeeping considerations, just as you're recording on a day-to-day basis, is making sure you reconcile your balance sheet accounts. I think that gets ignored a lot. I think a lot of the time bookkeepers will just focus on recording all the cash that comes in, recording the cash that goes out, and then nothing else gets touched. But it's important to know what's a receivable. Maybe you had an event and you had a sponsor that didn't make their $1,000 payment. It's important to know that in your books and reconcile your books on a monthly basis so that it pops up and you say, oh, we haven't received this $1,000 yet. Maybe then the bookkeeper could bring it to the attention of the executive director and say, okay, we haven't received this $1,000 payment. Can you reach out to this sponsor to make sure you receive payment? It's a good way to make sure that you're not missing any funds that you're expecting that should have been received. Let's see, anything else here? And it's also obviously a good way to manage payables. You don't want to see a payables on your books growing when in fact that you've paid them all out and you just needed to maybe reconcile the payments that came in. Another question came in. What about an outsourced accountant for segregation of duties with their own staff? Do you see a requirement for the client firm? So usually when you outsource your accounting to another firm, they'll usually have some sort of checks and balances within their firm. So usually maybe you don't have to worry about it as much. I would still have, these are your books. These are your accounts. So you should make sure that you're aware of everything that's going in and out of your bank account. So at the bare minimum. So so if all accounting responsibilities are handled by a outsourced firm, and maybe they're even paying your checks for you and recording all deposits, at the bare minimum, you need to be looking at your bank statements to make sure internally that everything that's going in and out of your bank account lines up with what your expectations are. You even have some sort of Excel spreadsheet of your revenues that you expect to be coming in each month, and compare that to what your outsourced accountant's doing to make sure that everything's being recorded correctly and is included in everything. As a CPA, what aspects do you look at that tells you the nonprofit is well run? I think that goes to one of the big things in a financial statement, there's a liquidity disclosure that shows what financial assets an organization has to meet its operating needs going forward. So what I'll look at is what are the cash reserves of an organization to meet its expenses over the next year. what are its net operating loss, what is its net operating income over the past few years, that shows how that gives you a good indication of how well the organization is managing its budget, and how well, at least from a CPA perspective. What a donor might maybe want to look at is, okay, what those program metrics that I mentioned is how does the money come in? How is that money being used by the nonprofit? Someone asked, can you give your thoughts on best practices for using your endowment? Do you find the majority of nonprofits who have endowments use their spin or percentage of draw to provide yearly revenue? Also, what expenses are below the line and above the line? How do you determine? I'm not sure I followed the last part of it, but as far as the for endowments, usually how it works is if you have an endowment, $1 million endowment set up, that maybe 10% of earnings each year can be used to support the operating needs of an organization. So then the organization could fit that into their budget and say, okay, next year we expect to get $10,000 from our endowment, from its investment income, that's proceeds that have accrued over the years. So you kind of build that into your budget, so that because that's money that you could use for your operating reserves. So that's kind of how you would use it. Obviously, you don't want to touch the corpus of the endowment. So if you had a $100,000 gift that was made to your endowment, you never want to touch that $100,000. The only money that you should be spending on your endowment is from the earnings on it. So in those first few years of your endowment, you probably don't want to maybe want to let that build over the first few years before you start then dipping into your endowment to use for kind of specific purposes. I think that's all I had there. Going back to my slide here, just making sure you incorporate your development and program personnel into your budgeting process, making sure you kind of have a lot of input from everyone, because they know that your program people know what expenses you need to run your programs, and then as you're developing a budget, then you can take that into account. Another good way to manage the in your bookkeeping, your income and expenses is, especially if you use QuickBooks, it's to set up classes in QuickBooks to show what expenses are being used for. So say if you set up your expenses in QuickBooks, one for program, one for administrative, one for fundraising, then when you have if you need to do some sort of mailing for your program, then you could charge that to the program class. And then when you get to the end of the year, when you're doing your 990, it makes life a lot easier when you can just do a profit and loss by class that shows your expenses for each different bucket. And then that's what you use for your 990. That's the best way to kind of account for your expenses on an ongoing base, on a day-to-day basis, so that at the end of the year you're not guessing, what your expenses were for. And kind of my last bullet here was to ask questions throughout the year. I'm guessing most people use a CPA firm to either do their 990 or have an audit. So I always encourage my clients to ask questions throughout the year, and not just at the end of the year. Don't bottle them all up and wait till the end of the year and then have all these questions that cause then you to have to go back and fix things. I much rather have people ask me questions throughout the year, so that I'm providing guidance in real time for you to kind of then make sure that you have accurate financial information to use for your organization. There's another question here. Is there a minimum amount recommended to begin an endowment? We've heard the fees to audit it can be significant in relation to the total of the fund. There are some kind of special auditing parts to an endowment. I wouldn't say there's a minimum amount. You probably don't want to start an endowment for $10,000 because it's probably not worth the administrative burden of it. Usually endowments are initiated from a funding source, where someone's going to give a big chunk of money and they want to make sure it's going to be used for a long period of time for your organization. So that's why usually endowments are created. It's to get a large amount of funds, pool a large amount of funds together so that the investment income can be used to support the organization going forward. If you only have $10,000 in your endowment, you're not going to be earning very much investment income on it. So it's not going to really be useful. And then you're going to be prohibiting yourself from using those endowment funds. So it's really, you want to have a good chunk of money in your endowment for it to really be effective instead of just being an administrative burden. Someone asked, we have new equipment donated to us. Do we need to set up capital assets for that donation? Yes. So say you received a new fridge for your office that costs $1,000. You would want to record that as a debit to your a capital asset, a fixed asset, as a piece of equipment, and then your credit would be to a in-kind donation. And then as that asset equipment is used over the years, you would then depreciate that asset as an expense. What is the minimum cost you would recommend for the capital item? I guess I would say, I think the minimum threshold usually somewhere around like $500, especially for a smaller organization. Bigger organizations can maybe use bigger numbers, like maybe $1,000 or $2,500. Really depends on the size of your organization. But at the lowest, I wouldn't go lower than $500 because then you're just creating administrative burden for yourself. And so $500 is really kind of the bottom line threshold. Then that could even get higher as your organization gets bigger. That's really, I think that was my presentation. Any other kind of final questions for me?
No, I think you've covered it all, Brian, and covered it very well. Thank you very much.
No problem. Yep, go ahead.
Any final words, Brian, before I wrap up here?
No, I'll just say this is my contact information. Feel free to reach out. I don't consider myself a bill by the hour person. So if you have questions or emails, feel free to reach out to me. I'm happy to provide guidance and any sort of input that I could help with anytime. So feel free to reach out, and I'm more than happy to help people.
Okay, that's fantastic. Again, thank you very much, Brian, for presenting today. And as a reminder, a recording of this webinar and the materials will be available within a couple of days on the fairfieldcounty.score.org website. As I mentioned earlier, we are very pleased to partner again with the Fairfield County Community Foundation in a 7-part series focused on assisting women and minority-owned businesses to start and grow their businesses. This series will begin on Wednesday, May 12th at noon for 7 consecutive Wednesdays. The program will kick off with Diane Winston presenting on So You Want to Be an Entrepreneur. Other topics in this series include marketing and financing your business and networking resources. Please register for this webinar and the other webinars in this series at either at fairfieldcounty.score.org. Again, SCORE offers free individual business counseling, so please use the link on the screen or visit our website and click Request a Mentor. Also, please fill out your evaluations that are being sent to you now at the end of this webinar. On behalf of SCORE, thank you to Danielle Marchion and the Fairfield County Community Foundation for partnering with us in today's webinar, as well as in the upcoming 7-part series. A special thank you to Brian for presenting today, and thank you for all for attending today's webinar, and I hope everybody has a nice day.